Thanks very much, Kay, for that introduction, and warm welcome to everybody that's joining us this morning, 15th of October. Can't quite believe we are halfway through the month already. So a lot to cover this morning. What we're going to be looking at is, well, as you've signed up for, the common pitfalls in VAT, and just drilling down into that a bit more. We'll start by looking at why VAT is so important, and then the potential pitfalls and issues that may crop up in relation to VAT registration, deal fees, place of supply, land and property, and then I'll be handing over to Alex, who'll be looking at issues with importing, director and employee expenses. And then whilst maybe not universally applicable, we thought we couldn't possibly do this presentation without touching on VAT on private school fees following the recent introduction. So why is VAT so important? Often, I think, VAT is sort of considered as the poor relative of all the taxes and sort of left unaddressed unless issues crop up, which is often the way that we are introduced to VAT advisory work. But actually, VAT's the second highest generator of income for the Treasury after income tax, so it really is vitally important. It's a tax on the supply of goods and services in the UK, so it's almost universally applicable. I think the other key thing to recognise is that it's a self-assessed tax. So the onus is on businesses to understand when VAT should be charged and at what rate. And this includes considerations such as the place of supply. So is the place of supply in the UK or is it somewhere else? Do you have registration obligations here in the UK or elsewhere? Are there obligations created under the reverse charge, which is a mechanism whereby businesses have to account for VAT on behalf of supplies received? And finally, understanding carve-outs such as VAT exemptions, reduced rates and reliefs, and when these should apply. So that there's a whole raft of things for businesses to understand and to get their heads around. And that's just looking at the supply side. So on the purchase side, it's, well, can you just go ahead and merrily reclaim VAT that you've been charged, or are there restrictions to that? VAT can also impact cash flow and profit. These are obviously very key considerations for business. And finally, if you do get it wrong, there are significant financial consequences. So obviously we're looking at penalties and interest. So that's sort of just a brief summary of why we need to be on top of VAT. So purpose of today, to go through some common pitfalls and also some quirks. So, you know, things that you might not necessarily consider, but could be advantageous. So if we start with registration, I think, you know, you may be thinking, well, why do we need to consider that? Surely it's fairly straightforward. You know, if you breach the registration threshold of currently 90,000, then, you know, there's going to be a requirement, a liability to register for VAT. And that's true. But there are also some quirks and things to consider, which we thought we'd just bring to your attention. So first is that if you're a business established in the UK and you're only making supplies outside the UK, there is still an entitlement to be registered for UK VAT. So registration has two paths, if you like. The first one is a liability to be registered for VAT, and that's going back to the threshold point that I made earlier. And the second is an entitlement to be registered. So that's where either you haven't breached the VAT registration threshold, or you're making supplies outside the UK that would be taxable if made in the UK. So say, for example, you've got a holding company, parent company in the UK that's making management recharges to subsidiaries based elsewhere, so Hong Kong, for example, and no other supplies are made, there would still then be an entitlement to register for VAT and for that holding company, parent company, to recover VAT on any costs incurred. There are also slightly different rules for non-established businesses. And when I talk about non-established businesses, I guess it's important just to explain what I mean by that. So for VAT purposes, a fixed establishment is created where there are technically, it's described as the necessary human and technical resources capable of receiving or making a supply. But what does that mean in plain English? It means that there are actually staff and resources on the ground to make or receive supplies. So usually that's staff and an office, but it can be a home working place as well. But what it does mean is that simply because a company is incorporated in the UK, there isn't necessarily an establishment in the UK if that incorporated entity doesn't have any staff or offices. So if you've got a non-established business, so just an incorporated entity with no staff or offices in the UK, and they're only making supplies outside the UK, that does mean that there won't be any entitlement to register for VAT. because the rules for non-established businesses are slightly different. So we've had instances where incorporated entities have asked us to register for VAT because they're incurring various costs, but they actually don't have any entitlement to be registered. Conversely, if you're a non-established business and you're making supplies into the UK, the liability to be registered is much greater, in the sense that as at the point that any supplies are made in the UK, whatever the value, there is a requirement to register for VAT. So another key area, just sort of thinking about that entitlement to register for VAT, is where a business hasn't begun making taxable supplies but has an intention to do so. And where that's the case, there is an entitlement to register for VAT. HMRC do require evidence of the intention to make taxable supplies, and actually they're becoming much stricter on sort of seeking that evidence and providing it to them. And that could be anything from a business plan, forecasts of income, emails with potential suppliers, contracts with customers, anything that will evidence that you have a firm intention to make supplies can allow you to register. And if you're a business that had that intention some time ago and still haven't registered for VAT, you can backdate the registration. And we've seen quite often with clients that this does create a significant opportunity to reclaim VAT on historic costs. So it can be quite a good one to be aware of. Final point on registration and quirky things to consider are holding companies. So if you've got a group structure with a holding company at the top, it does depend on what the holding company is doing. So some holding companies might be entirely passive holding companies, purely holding shares in subsidiaries. But if that holding company has an active involvement with the wider group, for example, dealing with strategy, looking at investments, acquisitions, for the future growth of the group, perhaps it's sharing directors' time or staff with other subsidiaries, or dealing with procuring group costs for subsidiaries as well, and in return for which a management recharge is raised, then that would give the holding company an ability to register for VAT and reclaim VAT on any costs incurred. I will also be coming on to shortly how this interacts with holding companies reclaiming VAT on deal costs, because that could be significant as well. But for now, just looking at the registration ability of the holding company. Just in terms of whether the holding company is passive or active, HMRC will look to see that there is a genuine economic activity being carried out by the holding company. So what that might look like is a management services agreement. You know, that would probably be the gold standard, if you like, if you were able to produce that to HMRC to say that this is what you're doing. The recharges should ideally be a genuine reflection of costs incurred by the hold company. And also there should be a genuine expectation that the recharges will actually be settled. So reading back through this when I was writing the notes, I thought, wow, I've made a lot of references to genuine here. And actually there's a reason for that. And that's because there have been lots of cases through the courts where holding companies have purported to carry on an economic activity and to manage the group as a whole and to recharge costs. But in reality, there was no management service agreement. That doesn't necessarily mean that there isn't an entitlement to register, but it does help a lot. Also, the recharges were minimal. They didn't reflect the actual costs incurred. And finally, in some of those cases, there was no expectation that the recharges would ever be settled. So in those instances, HMRC said that the holding company wasn't actually carrying out a genuine activity. So moving on to deal fees, I touched earlier on VAT recovery of holding companies incurring VAT on professional fees associated with deals. So here, what happens is often holding companies deal with the strategy of the wider group and incur professional fees in relation to acquisitions or disposals. And then you've got the question, well, can that holding company reclaim VAT on those professional fees? So the first hurdle is, well, is the parent company or the holding company registered for VAT? And we've just touched on that previously. If they're generating taxable income, as discussed, that will provide a basis for VAT registration and allow recovery on deal fees, which can be significant. But it does depend on the type of deal that is under consideration. So even if the entity incurring the professional costs on the deal fees is VAT registered, there's not always an entitlement to VAT recovery. So there have been a huge amount of cases exploring this concept, as you might imagine, because the value of VAT on deal fees can be extremely significant, which means that reclaiming such VAT has been litigated to the extent that it has gone to the courts in the UK and at European level. And the courts have held that there must be a direct and immediate link between the costs incurred and the taxable supplies made by the claimant, the entity seeking to reclaim the VAT. So just quickly going to look through a couple of cases. So the first one was the case of BLP way back in 1995. So we're 30 years ago now. In this case, BLP incurred VAT on professional fees in relation to the sale of shares in a subsidiary. And they sought to recover that VAT on those costs, saying that there was a direct and immediate link to taxable supplies of the business. But the European Court of Justice held that actually no, there was no direct and immediate link, because the direct and immediate link was the immediate exempt sale of shares. So just very briefly, a sale of shares is a VAT exempt supply. And where exempt supplies are made, any costs incurred directly in relation to an exempt supply cannot be reclaimed. So BLP were potentially chancing their arm, trying to argue that the sale of the shares in that company actually related to a step further on, which was the continuation of the taxable business that remained. And the European Court held that no, that wasn't the case. There have been a huge amount of cases in between, but jumping forward to this year, the most recent case was a case heard in the UK, Hotel Latour. And this case essentially sought to overturn the CJU principle established in BLP. Hotel Latour is a holding company and held shares in Hotel Latour Birmingham. They sold shares in Hotel Latour Birmingham, which, as we know from BLP, is an exempt supply, but they decided to go against the ECJ decision and reclaim the VAT. They said that they were entitled to recovery on the basis that the sale was to fund the development of a new hotel, which they were developing in Milton Keynes, and taxable supplies. And surprisingly, because they'd, I guess, put such a strong argument forward, the first tier tribunal in the UK ruled in favour of Hotel Latour. Now, knowing that this would open up the floodgates to a huge amount of VAT claims, HMRC appealed this decision, so it then went to the upper tier tribunal, who again ruled in favour of Hotel Latour. At this stage, it became a binding decision because first tier tribunal decisions are only binding on the parties to the case. At the upper tier, the decision becomes binding on everybody. Everybody can rely on that. So at this stage, it had kind of set hairs running. HMRC then appealed to the Court of Appeal, who overruled the tribunal decisions and referred back to the BLP case and said that that was correct law and that there was no direct and immediate link to the taxable activities of the future hotel that would be development, but in fact it was the sale of shares in Hotel Latour Birmingham. Hotel Latour have appealed to the Supreme Court. The case has been heard back in June of this year and the judgment is eagerly awaited, but it's very much thought that the Supreme Court will follow the BLP decision heard at a European level. Place of supply then, this is another common area of pitfalls. Why is that? It's because the place of supply of goods or services determines where that will be due. And if this is somewhere other than the place that you're established, then it could be triggering VAT registration liabilities overseas without realising. So it's important to understand the place of supply. So just very briefly, the place of supply of services, where supplied on a B2B basis, that's business to business, is where the recipient of those services belongs. And where supplied on a B2C basis is where the supplier belongs. So just briefly, with a B2B supply of services, just because your recipient belongs somewhere other than the UK doesn't mean that you've got a liability to register for VAT where they belong, because quite often, or for the most part, the reverse charge will kick in, which means that your customer accounts for VAT on your behalf wherever it is that they're established. There are exceptions to the place of supply of services, though, and these exceptions are predominantly in relation to land-related supplies, admission to events, and electronically supplied services. So we'll come on to that very shortly. Place of supply of goods is where the goods are when they are delivered or made available. So now that we understand the general principles, we can look at where the pitfalls may occur. So if everyone and everything is happening in the UK, then it's likely to be subject to UK VAT, and we're relatively happy with that. But what about business-to-business supplies of land-related supplies? So if you're UK established and you're making a land-related supply, and that land is located somewhere other than the UK, then the place of supply of it is where that land is physically located. So, you know, on the face of it, you might be thinking, well, that could just be a sale or a lease of land, but land-related supplies are quite wide-ranging and can be anything such as property management, interior design, architect supplies, surveyors, or even dealing with applications for planning permission or conveyancing. All of those will be captured by the land-related supply carve-out, if you like. And if you're making any supplies of those, then your supply would be where that land is located, potentially triggering overseas VAT registrations. Equally, moving on to admission to events and conferences, etc. If those events and conferences are taking place overseas, then you will have a liability to register wherever that event or conference is taking place. And if that jurisdiction has similar legislation to the UK, there will often be a zero registration threshold. So there will be an immediate requirement to register for VAT wherever that event is taking place. B2C, supplies of goods. Now, this will depend on the terms and conditions of sale. So it could be that under your terms and conditions, you say that the customer is responsible for importing any goods and paying any VAT or customs duties thereon. Probably not going to go down particularly well with customers who think they've just put something in their basket and that is the full landed cost. So any additional VAT and customs duties is not going to be very welcome for them. So if, as most retailers, you deliver the goods on a duty paid basis, this can create a registration obligation overseas. Similarly, electronically supplied services, so that can be supplies of apps, supplies of online training. The place of supply for those will be where the consumer belongs. It's not all bad news, though. To the extent that these are supplied to consumers based in the EU, there are simplifications which mean that you can make one VAT registration and account for VAT across all member states through that single VAT registration. So for goods, that's the import one-stop shop, and for services, it's the non-union one-stop shop. It is important to note, though, for the import one-stop shop, though, that only covers goods where the value of goods supplied is below 150 euros, and that includes transport costs as well. So if you're supplying goods of a higher value than that, then you will have a liability to register in each individual European member state. So I had a client who was selling post-Brexit, when this came in, sunglasses, and the majority of which had a value of over 150 euros. And immediately there was an obligation to register for VAT in each member state where they were supplying their goods. So for them at the time, they decided to just turn off EU capability for selling their sunglasses because just the cost and admin burden of administering that was just too high. So now moving on to land and property and common pitfalls here. So just briefly, the VAT liability of property turns up everything we know about VAT and goods and services. So the general rules for VAT is that everything is standard rated unless it is specifically carved out in one of the exemptions or zero rating reliefs or reduced rating reliefs. Property, just because VAT likes to be very complicated, turns that upside down. And with property, everything falls to be treated as VAT exempt unless it's specifically carved out in any of the zero rates, reduced rates, or if it's opted to tax. So zero rates will often apply to development and first grants of residential dwellings, relevant residential properties, so that could be care homes or student accommodation. Reduced rates can apply where you're converting dwellings or relevant residential property or relevant charitable properties. Reduced rates can also apply where you are renovating a property that has been empty for more than 2 years. And then you've got the potential to opt to tax property, and that mainly applies to commercial properties because in relation to dwellings or relevant residential properties or relevant charitable properties, that option to tax is automatically disapplied. So you can see that immediately with land and property, there's a huge scope for error there, because there are so many different VAT rates that can apply depending on the purpose of the property and what you're doing with it. But just highlighted a couple of the common pitfalls, and these are around the option to tax and the capital goods scheme, and also change of use. So when I talk about change of use, I mean change of use from a taxable to an exempt supply. So briefly, what's an option to tax? A supply of property, as I've described, is by default VAT exempt, but businesses can choose to opt to tax to allow recovery of VAT on associated costs. Something that trips people up quite often is that the option to tax sits with each interest in the property and not the property itself. So, for example, if you own the freehold in a property and you grant a lease, and you've opted to tax the property, you will charge VAT on the lease, your tenant will pay that to you. If the tenant then decides to sublet, then they need to decide whether or not to opt to tax the property as well. So it's not the property, it's each interest in the property. The capital goods scheme gives a fictional 10-year life to land and property, and it kicks in, it applies where the cost of the asset, so either the purchase, the acquisition of the property or the lease, or if you're developing or refurbishing a property, and the cost of any of those exceeds £250,000 excluding VAT, that will then create a capital goods scheme item, which means that at the end of each year, a VAT adjustment must be made based upon the use of the asset. So whether you've used that asset for taxable or exempt purposes. And just a side note, the CGS threshold will be increasing up to 600,000, although we do not have a date when that's going to be kicking in. So just to put the option to tax and the capital goods scheme into context, a brief case study, we had a client that was a fully taxable business, acquired a freehold in an office. The seller had made an option to tax, so our client reclaimed that on the purchase, which was around about 100,000. The client, as I said, was a fully taxable business, didn't think anything of it. 4 years later, sold the property without opting to tax. What this did was create a VAT exempt supply. And because the acquisition of the property had created a capital goods scheme item, it meant that the remaining 6 years of the fictional asset's life was an exempt use. And therefore, there was a £60,000 VAT assessment for the client. Unfortunately, they hadn't come to us for advice and just asked us to try and resolve it after the event. And unfortunately, sometimes it is too late. Not always, you can make belated options to tax, but in this case it was. Payback and clawback provisions work in a very similar way to the CGS, and they require an adjustment to VAT previously accounted for. But the only difference is that these apply where there's been a change of intention before the asset is put into use. So clawback is where VAT is incurred and reclaimed for intended taxable supplies, and then the intention changes before the asset is put into use, so that actually there will be exempt supplies, and payback is the opposite. So VAT incurred, not reclaimed, because it pretended that exempt supplies would be made, and there's a change of intention. We've had a recent case with a client who developed a care home, reclaimed the VAT on the build cost because they intended to make a zero-rated grant of the care home once practical completion was achieved. But due to funding arrangements falling through with the purchaser, they actually had to operate the care home for a short while within the property company. And therefore, a VAT clawback correction had to be made to account for the temporary period of exempt use. So something that you might not be expecting, but needs to be addressed. I'm now going to hand over to Alex, who will take you through the final few topics where you might encounter some pitfalls. So Alex, over to you.
Thank you, Kelly. So importing goods into the UK can be challenging with a wide range of potential pitfalls, and we find all the time the same errors happening, and they lead to avoidable losses with both import VAT and customs duties. So basically, when you import goods into the UK, import VAT and customs duties are generally payable, although subject to zero rates and reliefs. And these are generally required to be paid immediately before goods enter the UK market. Whilst customs duties that are paid are generally not recoverable, they can be deferred in certain circumstances via duty deferment accounts, and there are a number of reliefs that may apply to customs duties as well, which we often find businesses miss. Import VAT, however, is recoverable, provided the correct conditions are met, and this is where we find problems frequently arise. So only the owner of the goods can recover the import VAT, and the person that's recovering the import VAT needs to get the correct documentation to do so. So the person with the right to dispose of the goods as owner should be declared as the importer of record against their EORI number, and then they will be able to get the C79, which is the document that shows who has paid import VAT and entitles them to recover it, provided that the imported goods relate to onward taxable suppliers. The goods being imported, they also need to be associated with the correct EORI number to make sure that all the documents are in order and that the import VAT is reclaimable. It's frequent that we see the wrong EORI number go in customs documentation, especially where there are multiple parties, perhaps all part of the same group, and there are freight forwarders involved as well. And this is where we see errors arising, because where the wrong EORI number is on the documentation, people still recover the import VAT that they paid, and it's just the documents that mean that they actually shouldn't have done that. And this can lead to significant problems, especially where frequent importers of goods end up recovering VAT over a long period of time that they're not entitled to. Businesses looking to import goods into the UK are not always aware of postponed VAT accounting, which is a common area that we find people are still not using, and that leads to them suffering a cash flow disadvantage. So PVA was introduced following Brexit, and it's a simplification that essentially allows UK businesses to defer paying import VAT at the border until their next VAT return. So they pay VAT on the return at the same time as they reclaim it. This offers a substantial cash flow advantage, where in the past you would have had to pay VAT at the border and then reclaim it later once you got the C79. There could be another 3 months until your next VAT return, so you could find that you're paying import VAT and then it stays with HMRC for 3 to 4 months while you wait for it to come back. PVA prevents this, and it's a really easy thing to do. We just find businesses are either not aware of it or just aren't doing it because they're used to using C79s and paying VAT at the border. The process is slightly different, so you don't get a C79 anymore, and you need to make sure that you're filling out the customs documentation correctly to apply PVA. But where it is applied, you get a monthly statement that shows the import VAT that you've been paid, that you've paid to HMRC, and that entitles you to declare and reclaim it at the same time. As well as import VAT, the customs duties can be very complex, and we find that businesses often miss reliefs such as inward processing relief, outward processing relief, temporary admission, return goods. There's a very long list of customs reliefs that people aren't using, and where I said customs duties can't be recoverable, you can correct it if you've paid it in error, but it can be a really long, difficult process, and HMRC often aren't too helpful when you're going through that process. So when you're importing goods, you need to make sure that for customs duty purposes, you're classifying the goods correctly. You're also sure on the rules of origin and how to value those goods. And this is a minefield that a lot of businesses make mistakes with. And we think that regular advice is a good way to make sure that you're following the correct procedures and that the position is not only compliant, but optimized. Oh, actually, can I move on to the next slides? I'm going to have a quick look at director and employee expenses as well. So it's very common for both directors and employees to buy things for the business or on behalf of the business whilst they are carrying out business. So common examples are travel, accommodation, subsistence, and even professional fees that directors and employees incur in the course of the business. The question is, when is this VAT reclaimable? And the answer depends on 3 key principles. So the expense that's incurred needs to be incurred for business purposes, as is the rule for all expenses. The cost must not be specifically blocked from recovery, which is an area we find there are often problems with and frequent errors. And they must have a valid VAT invoice to support the right to recover the VAT as well. Third point is fairly uncontroversial, although we still find that frequently businesses are reclaiming VAT without valid VAT invoices, and that does lead to penalties from HMRC. Especially at the moment, we've noticed HMRC are being particularly keen with with VAT checks. So it's important to make sure that all the correct documentation is in place. But still, so the first 2 points are where it gets a bit more complicated. So what is wholly for business purposes, and are these costs blocked? So businesses can generally recover VAT on employee and director expenses when those costs are incurred for business purposes. But frequently we find there's some blurring of the lines in the minds of business owners and directors around what is a business expense. So for example, traveling to and from specific meetings outside of your regular workday would be normally considered a business expense, but driving to and from the train station to go to your office would not generally be a business expense. So there's often a grey area, and it's important to consider what costs are and aren't for the business and whether there's any private benefit. And I'll have a bit of a more detailed look at that in a second. But on the invoice point, HMRC do actually allow businesses to recover VAT where the invoice is not addressed to the business, where it is incurred by directors or employees in the course of the business, provided that it is incurred wholly in the course of the business and that the business reimburses the employee or director who's paying. So it's important that people keep records of this, showing that the business has actually reimbursed staff, and that's important for if HMRC to come and check. There are some pretty complicated points in this area, and there's quite a lot of case law around this, such as P&O Ferries, where a company had paid for legal fees to defend its directors from a corporate manslaughter charge following the Zeebrugge disaster. And the question was whether or not those costs were really for the benefit of the business or for the benefit of the directors being defended. So this, ultimately it found that there was a benefit to the business. The business had appointed the solicitors, and the defense of its directors was for the benefit of the business, because if they were found guilty, that would have a negative impact. But there's a lot of case law around this point, and it's really important to consider on a case-by-case basis whether or not specific expenses incurred by directors or employees are for the benefit of the business. Given the complexity on this point, we often find problems in the area. Frequent areas include, as I mentioned, travel to and from work and subsistence on those journeys. But in addition to making sure that costs are actually business related, it's important costs are recorded in the correct way. And we've seen frequently, for example, systems that aren't necessarily robust enough for recording employee expenses, where even if an expense is incurred VAT-free, for example, at a zero rate or exempt, when they record that expense, VAT goes against it in the system just by default. And that can lead to businesses recovering quite a lot of VAT over a long period that was never actually charged. So having the correct systems in place to make sure that isn't happening is also very important. And we would recommend robust systems and checks are in place to make sure that only VAT that is charged is actually claimed. Recently, we worked with a client who was looking to sell their business. And during the due diligence process, it came out that, actually, move on to the next slide. It came out that they hadn't had good systems in place to prevent this, and they weren't necessarily aware of all the rules. So they've been claiming input VAT on a number of different costs over a long period, and this really added up. During the due diligence process, when they were looking to sell the business, this was identified, and it was a very long, costly exercise to identify where the errors were. So just looking at what they were reclaiming VAT on, vehicle leases, such as car leases for directors and employees, where a business incurs VAT on leases of cars and provides these to its staff with any degree of personal use, then 50% of the VAT that is incurred on those lease payments should generally be restricted. And this is one of those things I spoke about earlier, is the VAT specifically blocked from recovery. So the business in this case hadn't considered this, and it had a large fleet of vehicles that were available for personal use, and this really created quite a significant problem. Adding up all of the VAT they claimed an error over 4 years on their fleet of vehicles was quite an eye-watering number at the end of it. And if they were aware of this at the outset and had followed the correct processes, that wouldn't have happened. They're also claiming all VAT incurred on business entertainment, which is another area where input VAT is specifically blocked by a special legal provision. It can be quite a complicated area, but as I've mentioned, businesses can normally recover input VAT incurred on goods or services for business purposes. This is not the case with business entertainment. There are a couple of exceptions to that, but I won't go into too much detail. But essentially, you can't recover that VAT. And again, adding that up over the 4-year period was quite substantial. Other areas include property costs that had been incurred for the director and clothing for directors and employees. Clothing is a really interesting point because normally people are responsible for their own clothes at work, and a claim that a high standard of dress is required, to appear professional and to look good in meetings doesn't make you buying your clothes a business expense. Although there are some instances like uniforms and branded clothing where that's not, it's a bit of a grey area sometimes, but protective clothing, for example, is fine. But yeah, just having luxury clothes and recovering the VAT on them is generally not acceptable. And that was also quite a big amount over the 4-year period. So you get the picture that whilst in isolation, reclaiming a bit of VAT every now and then on a cost that may be a personal cost wouldn't create a huge problem. It really does come out and it adds up. And at the end of these processes, you have a 4-year period to correct any overclaimed VAT. And it can really add up quite a lot. And in this instance, it led to significant payments being made to HMRC by the directors who were selling their business. This could all have been avoided if they'd have just made sure the correct processes are in place and taken some advice to make sure this wasn't happening. So finally, I'm going to have a quick look at private schools and the private school fees. Oh, I've gone too far. There we go. So most people will now be aware that private schools are required to charge VAT on their school fees. This has been unavoidable in the news. Everyone must have heard about this by now. But there are some more complicated points around that, and there are also some opportunities that arise as a result. So the anti-forestalling rules, for example, came into effect much earlier than the actual legal provision that the school fees would be liable to VAT from the 1st of January 25. So all school fees charged after 29th of July 2024 by a private educator that relate to school terms starting on or after 1st of January 25, all that income is now liable to VAT. And we have seen this as a problem with a few private schools, that they'd missed the anti-forestalling rules. So they thought, being clever, they'd raise invoices maybe in August 24 for terms starting after the 1st of January 25 on the basis that that income wouldn't be liable to VAT. However, that has led to some substantial error corrections. So it's the anti-forestalling rules have been missed, and we know there are errors out there. We've seen some of them, and it's just a common pitfall that we wanted to bring up. Yes, so it's more complicated than just changing from standard rated to from exempt to standard rated as well, because there are still many areas or many specific items that a private school can charge for that remain exempt. So that means that there are now a substantial amount of private schools that have never dealt with VAT before that are now having to charge VAT on some of their fees, but leave some of their fees as VAT exempt as well, and then carry out complex partial exemption calculations and annual adjustments to restrict their input VAT recovery on overheads and specifically allocated costs relating to exempt income. So many schools we have seen have worked around this by charging only one single fee to the students or to their parents, being a supply of private education, and the whole fee is then liable to VAT. This prevents them having to deal with the partial exemption issues, but it does mean that they are charging more VAT because they're not benefiting from the exemptions that could apply to other certain costs. So we've seen a mixture of schools. Some of them are simply charging VAT on the whole amount. Some of them are opting to deal with partial exemption. We've been helping schools on both sides of that fence with input VAT recovery, with implementing their systems to make sure they're recording VAT correctly. And it's been really challenging for a lot of schools. And we're aware that there are still problems out there, and there are many that probably do still need support in implementing the correct systems and processes. Whilst implementing VAT on private school fees has caused some problems in the sector, and it has made things a lot more complicated for a lot of private schools, it has created opportunities. So as Kelly discussed earlier, there's the capital goods scheme, which presents a significant opportunity for private schools, many of whom will not be aware that they have capital goods scheme assets. It's a great opportunity for them to go back and look at the VAT that they originally didn't reclaim on buying land and property or redeveloping, refurbishing existing buildings. It's a great opportunity to see how much VAT they could actually go back and claim. This is unfortunately quite complicated for the partially exempt schools, because the partial exemption calculation will feed into the capital goods scheme calculation, and they all feed into different VAT returns, and it can become really quite complicated. But with the right advice and the right assistance, you can navigate this complicated area, and it actually can be quite a positive thing. So, for example, we recently helped a private school in London by doing this. They are partly exempt, and they do have capital goods scheme assets that they weren't aware of. And by carrying out these calculations and working alongside them to classify their costs and identify any assets, we've managed to find them hundreds of thousands of pounds that they can reclaim over the next 6 years. So whilst it is a lot more complicated now for private educators, there are opportunities there as well. And yeah, it's a challenging time, but it's an interesting time for them. So I think that's it from me, and I'll pass you back over to Kate.
Thanks very much, Alex. So yeah, that was we tried to sort of canter through. There's quite a lot of material there, and quite a lot of scope for getting things wrong. So it's just trying to think about which ones might be most widely relevant, and hopefully you've got some good takeaways there. But just to sum up, how can RPGCC support you? Well, we've got a dedicated team of specialist VAT advisors to understand the nature of your supplies and advise on your VAT obligations, whether that's in the UK or elsewhere. We take pride in demystifying complex tax legislation. Wow, who wrote that? Maybe me. But seriously, it's very complicated, but this is what we deal with day in, day out. And we hope that we can convey that complicated legislation and all of those guidelines in a way that you can understand and put in practice for your business. What does it mean for you, essentially, so that you can get on with your day job? We can also manage UK and EU VAT registrations, and we have a sizable VAT compliance team as well that can deal with the quarterly or monthly returns for you. So lots in terms of support. So that's us. These are our contact details. I think as Kay said at the beginning, if you'd like a set of the slides forwarded to you, please let her know. Kay, have we had any questions come in?
We have. Thank you very much, Kelly, Alex. The first one I've received is, if you have not opted to tax, can it be done retrospectively?
Okay, let's get Alex in the frame here as well. Yeah, it's a good question. The answer is maybe. In some cases, you can retrospectively opt to tax. It does depend on whether you've already made exempt supplies of the property and whether you've reclaimed VAT in relation to the property as well. But there are instances where you can submit a belated option to tax. So if you haven't already done so, it's not too late. I think the scenario that I talked about, it was tricky because it had all happened after the event, after the final sale had taken place and the exempt supply had taken place. So it's difficult to evidence that an option to tax had been made. But if you're still sitting with the property and haven't made exempt supplies or any supplies, then yes, there is scope to do that.
And we have one more. You need a crystal ball for this one. What will the Chancellor do in the autumn budget? Will she be increasing VAT?
So the government have said that they're not going to be increasing the rate of VAT. But what we're thinking, Alex, isn't it, is that potentially there could be changes to the registration threshold. And I think there's been, in the media, it's been touted that that could either be reduced to 30,000, which would bring almost every business into the scope of VAT, or increased to a higher rate, maybe just up to 100,000. So that's one of the changes that could happen. And then the other one is changes around scope, liability of goods or services. So, for example, we've talked about exemptions, reduced ratings, etc. And it might be that the government decides to bring certain goods or services into different exemptions or relief. So, for example, there was talk about making private healthcare taxable in the same way that VAT was introduced on private schools. And I think actually the health secretary has come out and said that's not going to happen. But that gives you an example of the sorts of things that the government can do without increasing the VAT rate. So, but we do have a webinar, a post-budget webinar scheduled for, is it the 28th of November, Kay? So we will be going through the tax implications of the budget in detail. So do sign up for that, and we can, at that point, tell you what the changes are and how that might impact you.
Thank you very much. I think that is it from us this morning, almost dead on 10 o'clock. Thank you for joining us. Kelly, Alex, thank you very much for your time. And I wish everybody a lovely day. If anybody does want a copy of the slides, I know I've had a couple of emails this morning. Please do drop me a line at hello@rpgcc.co.uk. Thank you.
Thanks, everyone.